showing up. Thank you for being here. It's the 8th annual Startup Boston Week. It's amazing. All of you guys look great. We're going to get started. I hope you guys are as pumped as I am. Our panels are here. Our moderator is here, ready to kick off things. So we're excited. Can I get a woohoo? All right. Thank you. Again, and a huge thank you to Suffolk University Sawyer Business School for hosting this conference. As you have may noticed, arriving in this downtown location, it's the perfect hub for exploring Boston's innovation ecosystem and learning from industry leaders. The goal behind Startup Boston Week is to connect the entire greater Boston area and also New England startup community. I'm from Maine, and I'm here. So can I get a cheers for Maine, please? Yeah, there we go. And also just all industries, really, all startup departments, all bootstrapped in funding stages for 5 days of learning and connecting with one another. The team that created this Startup Boston Week is primarily volunteer, and they're just volunteering their time. So if you see them around, please give them a pat on the back, give them a shout out. So again, thank you for attending this conference. It's a labor of love, and we appreciate you playing a role in shaping our community. And I'll let my man take it from here.
All right, thanks, Mohammed. How about a little clap for our volunteers? Well, welcome everybody. This is going to be a very fun subject. It's an unusual one for the startup world to be talking about debt, but we're going to talk about all the different ways debt can impact startups. To start out, can I just see show of hands, how many people are actually founders or entrepreneurs? And follow-up question, leave your hand up if your revenue, say, is over 5 million or you've completed your Series A. Okay, I saw one half hand in the back. They're trying to hide. But in any case, so we've got some earlier founders here, and we'll try to gear the conversation a little bit more toward that. My name is Ian Levine. I'm a managing director at Launchpad Ventures, which is the largest seed funder in the Boston area, which means we do equity price deals for Boston-based startups, New England-based startups, usually $1 to $2 million raises. But then we have a very large portfolio of over 50 local companies that as they grow, they have different inflection points where they're starting to think about, how to use devices besides equity. With that, I want to introduce the panel, and I'm going to have them introduce themselves. Jennifer?
Yeah. Hi, everyone. Really excited to be here. I'm Jen Audi. I'm a partner at the law firm of Foley Hoag here in Boston. We're down in the Seaport. My practice ranges from representing startups in the earliest stages, literally formation and the two founders or one founder coming together, to exit in either merger, acquisition, or IPO. Fun fact, I went to law school right here, and my blood pressure rose just a little walking through the door thinking there was going to be a quiz or test or something. So, you ask me all the tough questions, I'm mentally ready. I work a lot on debt financing, particularly venture debt with our early stage companies, but also convertible notes, those angel rounds, bridge notes, the whole spectrum. So we're going to get into some of those.
Great, and morning everyone. I'm Mike Rossi. I've been a CFO in healthcare and medical device businesses for some time, mostly in the middle market is where I've operated, and I've operated in companies with a high amount of leverage, typically, including seeing the pros and cons of what operating with debt can be. And I'm currently working as a fractional CFO with an organization called Life Science Associates, mostly working with small, early stage medical device businesses.
Thanks, Mike. Obviously, we're a very small panel. I actually, 5 minutes ago, I Googled, what is a speaker panel? They said 3 to 5 people. So we're more of a fireside chat. And in the spirit of that, we're actually, if you have a question after something is said by any one of the three of us, just raise your hand. We're going to take questions real time a little bit if they pop up, because we are a smaller group. With that, I'm just going to turn it to Jennifer. Just generically, Jennifer, what are you seeing in terms of instruments being used in the market and equity derivatives, et cetera?
Yeah, so there's a lot of different flavors an investment can take in either equity or debt or something in between. And so just like to take a real big step back, right, there's equity on your balance sheet, and that's investments that come in the form of stock. And then there's debt, and debt always sits at the top of the stack. So when you're thinking about liquidation, debt goes back first. You have to pay it back. Equity is everybody's hoping to get a return on their investment. So first thing to come in, common stock. Usually that's what the founders are getting, employees, and then from that, options. Then you've got your friends and family, those early funders. Again, that's usually going to be maybe common stock, but it's most likely a note, and it's most likely convertible into the next round. Then there's safes, and they're supposed to be simple, as their name implies. They start simple. If you go to the Y Combinator website, which is where they started, there's 4 flavors, but really there's like 5 that people invented. Then you tack on a side letter and all this other stuff. Then there's convertible notes, and those will range in sort of a discount or a cap. Then you get into the later stage, preferred, Series C, Series A, Series B. So all along the way, you're sort of answering to different investors and their needs, and keeping in mind, again, coming back to that stack, who's going to get paid first if there's not an exit or there's a liquidation or something like that. So lots of different options to choose from.
If I could just add on to that, it's sort of one way of thinking of it as somebody that funds companies is each funding round requires another milestone to get to it. And if you don't reach that milestone, all of a sudden you may not be able to get the next round. So as an example, you start with the friends and family. They take 10 or 15% of your money in exchange for the raise. And then you go to a seed and they take 20, 25% of your company in exchange for that raise. And then all of a sudden, you have not hit your Series A milestones. You're not ready for Series A, but you need more money. Now you've got to start thinking about other sorts of instruments based on the progress that you've made that you could get at. But with that, Mike, why don't you just give us high level, what's the advantage of debt, disadvantage of debt? Just give us, as a CFO, just how you think about debt a little bit.
Sure. So when I think about kind of the pros and cons of having debt, the first thing I think about is, it avoids dilution in the business, basically. So you're not having to add extra equity and ownership percentages that you get on the upside of your business is obviously important. So there's no dilution. The other thing, it's ultimately a lower cost of capital. I mean, lenders, I remember first time I was going through a debt raise, the lenders were like, look, the best I can do is get my principal and interest back, basically, versus the equity owners are looking for more upside and participating there. So they're taking on more risk. And therefore, the overall kind of cost of capital is going to be lower from having debt. The other thing I think about is kind of your control over the business. When equity owners come in, they tend to want to have influence, right? They're going to have some level of control. They're going to want board seats and have a voice in the business that can be good or bad, but that's a thing you have to manage, basically. And ultimately, though, I think a debt owner, because they have kind of contractual rights to get cash out of the business, they're going to be, as long as you're paying and so forth, they're just going to be there, and they'll probably be a little bit more patient from a capital perspective versus kind of aggressive, milestones necessarily that an equity holder is looking for. When I think of kind of the cons of debt, it's Jen talked about how the stack is. I mean, debt holders have to get paid back, right? They're contractually obligated to, you are to pay them back principal and interest, and so that is just a risk and obligation of the business, effectively. So the other thing is, typically with many kinds of debt with a bank, typically there's going to be covenants with that. So that's either things that you have to do affirmatively or things you can't do. And why that's an issue is because that's what creates risk in the business, is ultimately if you breach these covenants, that typically will give the lender a right to ultimately call the debt to have it paid back. Which can lead to things as bad as bankruptcy of the organization. But I mean, oftentimes what I've seen is, if you're just a little off or whatever, they're typically they're better off getting paid back over time and not kind of restructuring the debt. So they'll try to restructure covenants and things like that. But that's going to take time, and that's going to it's going to cost you money as well too. And then the last thing I'd say is, probably for an audience like this, a big part of debt that might be available to you is venture debt. And that's going to come at a little higher cost in terms of the interest rate, but they'll also typically look for an equity kicker with that, with warrants, so there will be some level of kind of dilution with that. So those are kind of the things I think about as kind of a high level pros and cons for taking on debt.
Jennifer, anything to add on covenants and how you advise your clients on them and how to think about them? And covenants is a broad term. I mean, I know I've been part of an LBO where we went private equity, and all of a sudden we had all these ratios that we'll get Mike to comment after you, but it's like sort of like all of a sudden there's all this new math and new ways you have to think about your business in terms, because the banks have sort of figured out all these formulas. But go ahead, Jennifer, tell us what you've seen on the covenant and debt side.
Yeah, I think, there, like you said, there's a couple flavors. There's financial covenants. I would say for folks at the early stage, you're probably not going to have those. Financial covenants are more, middle market and larger operating companies where they're really trying to measure your financial performance. Then there's the operating covenants. And, what Mike said, what you can and can't do, I call them thou shall and thou shall not. That is your new master when you've got debt. And I have this conversation a lot with early stage companies with their first round of debt, when I'll explain, like, okay, it says here, you can't dispose of assets. And the comment back, what do you mean? They can't tell me what to do. Well, they can, and they will. And you're going to have a whole list of things that you must do. That's usually reporting, notices, financial statements, giving them access to your business whenever they want it. And then the things you can't do. You cannot go and sell your assets. You cannot, enter into a merger agreement. You cannot go off and sell your IP. The big exception there that I always like to make sure people understand is that's the general standard. Then you get a consent, you get a waiver, and Mike was talking about this a little bit. There's restructuring that you can do. And the idea is they're trying to sort of fence in their risk a little bit. So those are the things keeping them up at night. What's the risk on this investment, and how do we control it? There's what's market, right? And that's where your advisors, I would say if you're getting one of these facilities, call a lawyer. Doesn't have to be me. Be great if it was. But they'll talk you through what's market, what's normal. Then there's what can you live with? That's always my first question to a client is, we've got these operational covenants. Does this work? And a lot of times the response is, I just got to get the deal done, which is true, right? You need the cash. But you've got to live with that for, usually it's 5 years on a typical facility. And if you don't, now you're in default. And if the loan is secured, that means they come and take your stuff. So it's really making sure you, as the business owner, understand what these covenants are. Can you live with them? Can you meet them? Do you have a good relationship with your lender? So if there is a problem, you can work it out. And then making sure you understand the consequences for non-compliance. The worst case scenario that keeps me up at night as a counselor for these companies is the big default and bankruptcy or foreclosure. The flip side, I think, as Mike touched on, is nobody wants to do it. It's expensive, it's bad reputation, but it's there. That is their legal right because it has to get paid back. So that's sort of how I start the conversation when I'm advising clients on these.
Mike, can you just give us an example of one or two ratios a bank might, say, that become covenants? It's sort of like, I'm assuming that there's not a lot of bankers in the room, and they probably haven't borrowed money on the corporate level like you have, and sort of, what are they holding your feet to the fire against? What sort of ratios?
Yeah, some of the ratios they look for, most commonly, again, and this is kind of in a cash flow stage company, is kind of a maximum amount of leverage. So your debt to over your cash flow, your EBITDA, is typically what they look at there. Sometimes there's kind of a maximum amount of capital expenditures that are required. They'll look at ratios of your cash flow to kind of interest expense. And also with earlier stage companies, what I've seen is with tech companies that is kind of look at like a minimum amount of recurring revenue, basically. So those are some of the type of ratios you'll look at. And that's just something you need to be mindful of as you kind of set up your business and monitor the business from a control perspective.
And I would say, another thing to think about, you've probably heard of this in the early stage, there's when you can't have financial covenants, right? You're too early for that. The banks usually will look, or private credit will look to a MAC, which is a material adverse change covenant, or investor support clause, right? That's kind of how they're underwriting the business if you don't have financial covenants. So, they're going to say, look, if we see a material adverse change in the business, we're calling the loan. What does that mean? Have to litigate it, I'm not sure. Or investor support clause, which says, look, we're really underwriting your investors here. We're underwriting people like Ian standing behind your business. And if they back out, we're out, right? And that's That's sort of the trigger that they'll pull. So making sure you understand those two. And then, I think we've got an expert right here, right? So for your portfolio companies, they're thinking about taking on debt. I think it'd be interesting maybe like how you see it as an early investor.
Yeah, no, I think that's important. So let's bring it back to the early investor, and let's not make debt the devil here, because it's actually a very good thing. It can really help with founder dilution. It can really help with growth. I'm going to share a couple of stories. So one, I'm on a board of a liquor company or wine business, and when they had less than $1 million in revenue, we raised close to $2 million in equity, a little over $2 million in equity. And after that raise, they never did another equity round. They started borrowing slowly against their inventory with a bank, and they had to nurture that bank relationship over time. They eventually outgrew that bank, went to another bank, and flash forward to today. It's a $70 million business that's been with $25 million of inventory that was built entirely with credit facilities and debt, besides the original $2 million of equity. Why is that important? Because today, that founder owns just under 80% of the business. That's a really attractive situation, obviously, as a founder. It wasn't, every year wasn't beautiful. You do run into, some tight credit line situations, and just like, finding equity, you've got to find the bankers that are willing to lend you the money. Converse that with another story where I'm on the board of a software company, roughly $1 million in revenue, and we raised for them a few years ago. They came back like 9 months later. They needed a little topping off, which isn't that unusual. So at Launchpad, we helped top it off with some other investors. They then came back a year later, said we had a little bit of churn. We're still growing. You should still love us. We gave them a little bit more money. And then business just slowed down a little bit, and cash got really tight. So we actually had to do two things. We had to issue a convertible note, which I'm going to turn to my panel, talk a little bit, to educate on what that is. And we also turned to Mass Ventures, where we said, we actually have revenue, we have growth, we're Massachusetts-based, can you lend us some money? And the reason you had to is because folks like myself and the Launchpad and the other investors, you're kind of getting a little tired. They've, it's 24 months in, and they've come back to us, the original plus 2 more times, and you're kind of like, okay, I can't just keep giving you money. We've got to slow the dilution, and we've got to see more progress. But with those 2 quick stories, why don't we talk about that earlier sort of convertible debt, revenue financing, other things that earlier stage companies can do?
Yeah, so I'll talk about convertible debt. I think that's the most common that people would see. Certainly before the SAFE came along, it was sort of the first time companies were dealing with, debt and a different type of financing other than the traditional equity. And so convertible notes are, they're debt instrument, they're debt on the balance sheet, they're top of the stack. They're typically unsecured. And I say typically. I've certainly done my share of secured when investors are nervous about the risk. They typically have a 1-year maturity. And what will happen is they say at the next preferred round of financing, and we'll define qualified financing to mean you raise 10, 20, $30 million at such and such valuation, the notes will convert. And because we took a risk early, we're going to get a discount, or we're going to get a valuation cap so that we get a better deal on participating in the preferred round. So if it works, the idea is it carries you over until your first preferred round. Those notes convert, probably at a discount, and your convertible note holders come into the round as Series C or Series A holder. So that's how it should work. Usually what happens is you don't raise in the first year, and now you've got a note that's matured, and some investors might want their money back, or you can convince them to extend a little bit. Another common one you mentioned was the revenue financing. So this is a concept where it's a traditional credit facility. It is often secured, where you agree to borrow X dollars, let's call it $1 million, and it's going to get paid back based on a percentage of your revenue. So if you don't make a lot in one period, and how you define that, again, gets negotiated, your payment is smaller. And if you make a lot more, your payment is bigger. But the idea is it's capped at this is what we've borrowed. There's equity versions of this where it just keeps going, right? The spigot doesn't turn off. If anyone's watched Shark Tank, that's a favorite mechanism of Mr. Wonderful, I believe, is the constant revenue stream. So you just have to understand the instrument that you're using, and this is where, again, if you're not going to call a lawyer, call your advisors, call your board members, your founders, because these things can get real complicated real fast, and you just have to make sure you understand them. But very creative solutions out there to get funding to early stage companies, and you just got to find the one that fits for you.
Jennifer, can you tell people what top of the stack means?
Yeah, so top of the stack, I keep using that phrase. So that's, again, who gets paid first in a liquidation or an exit, right? Even thinking the best case scenario, right? A merger, big merger, tons of money. Whose money is going out first? And so debt is always top of the stack. And that means convertible notes. That also means your accounts payable, your trade payables, any equipment financing you might have, taxes, right? That's all debt on the balance sheet. That's got to go out first. Then whatever's left over, that goes to your equity holders. And again, if you've got preferred, remember the preferred's going to have a preference. Then it gets down to common, and you sort of dividing up what's left. And so I think, to something Mike said earlier about the debt holder, the pressure there, they have to get paid back. The best they can do is their principal and interest, and they want to make sure they're going to get it. And so you've sort of got to be aware of sort of, if you're looking at an exit scenario, whether it's good or bad, they're kind of looking down just to make sure they're getting what they're supposed to get. And they don't care so much about your equity holders, right? They've got to get their money back. So whenever I'm talking about the stack, I'm talking about that sort of preference and who gets paid.
Mike, can you talk a little bit? I know you did a lot of mid-market and larger private equity in your career, but this seems, at least in my experience, there is an industry flavor to this. You've got a med device background. That's a little bit different, especially at the earlier stage. Sometimes there's no revenue. You're waiting for regulatory approval of your device or what have you. Can you just give us a little bit of color on how you think about debt in those sort of situations?
Yeah, I mean, it's definitely going to be harder to secure that, given the fact that there isn't cash flows yet or revenue to secure and so forth. But it is possible to do that, and I think that's where oftentimes you'll see kind of venture debt come into play there, basically, and where that's what they're going to look for is, one, is there really good equity behind this, in terms of the credibility of the people that own the company and so forth. That will be important. At times, people will want to come in. If they come in with debt, they'll come in when there's other equity kind of going into the business. But I think otherwise, it's going to be that they're looking for clear pathway towards revenue and profit in the business, basically. So you see that with biotechs, that there's milestones been made, and that there's kind of a tracking that you're going to get there in a reasonable period of time to do that. So it is available. It's just tougher to do.
Jennifer, picking up on, you have all sorts of different clients in different industries. When they're coming to you with advice, and believe me, people go to their lawyers for advice on debt as well as legal stuff. But when you're giving your clients advice on when to take on debt, when not to take on debt, and sort of, if it's close to an exit or not, or by industry, just high level, like, how do you think about that?
Yeah, my first question is always why. Why are you looking for debt? This scenario is, they're looking for a facility, maybe not a bridge round or convertible note. Like, I know why you're doing that. But if you want to go out and get a facility, it's why. And sometimes I have plenty of companies who say, I never plan to draw on this. I just want it there as a safety net. Or their investors are saying, go get that lined up because we want it in the background. And that's a perfectly good reason. But if they're not sure, or it's just they got a call and someone said, let's get some debt on the balance sheet and it's a good rate, I'm really trying to dig in and understand why. And then what are you going to use it for? And I think the most important is, can you make the interest payments? Early stage debt is typically interest only for about a year and a half maybe. So you got to be comfortable you can make those interest payments. And then you have to be comfortable that you'll be able to make the amortizing principal payments when that clock runs out. We saw, and I think we're going to talk about this later, but leading up to the whole SVB debacle about a year and a half ago, leading up to that, there was a huge push for venture debt. Everybody was getting it. Investors were pushing for it. Companies were grabbing it. The banks were out there offering it. And they all had these interest-only periods that ran for 12 to 18 months. And then they stopped. And all of a sudden, people couldn't make the principal payments. And capital was getting tight. And there was a real stretch where people were trying to figure out, how do we make this work? Do we refinancing it? And then you had, on top of it, the, apocalypse that nobody saw coming. So you really just have to be comfortable that you can handle this and you have a way out if you need it and your investors are behind you. And then we get into things like, what's the security? Is it a secured loan? Are you comfortable with it? What's the exit going to look like? How are you going to pay this off in 5 years? Are you going to refinance it? It's definitely a conversation. And it's definitely a conversation about the right lender. Is it the bank? Is it private credit? What does that look like? One's more expensive. One's going to want an equity kicker, and sort of making sure everybody sort of understands the dynamic you're entering into. And then we'll talk term sheets if you still want to do it. But it's certainly an ongoing consideration.
Yeah, so I've also seen debt used in conjunction with equity, Ryan, simultaneously. You do, I'm going to take this much dilution with equity, but you've got something to borrow against already. So I'll take a smaller example and a larger example. They're real life examples for me. One, we were financing it wasn't a launchpad deal, but we were financing a $3 million revenue software company. We raised $1.5 million. It was the first outside money they ever took. We raised $1.5 million for them. But then simultaneously, we arranged for $1 million of debt for the company. We were able to grow that company to $8 million and exit. So it was perfect because I, as a new investor, took on less dilution, and the founder took on less dilution. Back to the stack. When it came time to pay back, when we got the proceeds from the sale of the company, the bank was paid back first. That's just the way it works. And the bank was very happy. It was good for the community. It was good return for them, and they achieved what we wanted. But the founder ended up saving himself, probably 10% of the money on a north of $15 million exit. So, he made himself a lot of money by using debt wisely. Debt can turn the other way on you, though, too. I'm actually a limited partner in a hybrid equity debt fund that's focused on Series B and C companies. So, much more mature, north of 10 million revenue is kind of where they start getting conversations with this entity. And I actually invested in one where we put in, we were in the Series D. We all put in money. We raised $500 million of equity, and they actually put in $1 billion of debt. I know those are hard numbers to concept. That was 2.5 years ago. This past February, I wrote that down to zero, and the company went bankrupt. So debt can go both ways. You can lever it up real fast to grow your company and improve your returns, but if it turns the other way on you, it can be painful. And I guess with that story, I don't want a painful story, Mike, but do you have examples of how you've seen leverage work and not work through your career?
Yeah, I guess ultimately you have business plans, and aspirations as to where you think you're going to go, but the world changes sometimes, and where you're going to go is, revenues go down, things like, best real world example I have is I was with a company that was highly levered and typically had kind of predictable revenue streams, but then COVID happened. And that's kind of an extreme example, but events happen outside your control that can lead to basically your cash flows and all the things that the lenders are looking for, go south effectively. So that's, and that's probably where overall, and a couple times in my career, it's when kind of economic conditions have changed meaningfully. That tends to put pressure on the business and its cash flows and other conditions. So that's that happens. There's a lot of things outside your control that can happen with.
Mike, with a founder thinking about possibly taking on debt, how would you sort of counsel them to think about let's assume they've got some repeatable customer recurring revenue, but it's not really large because we're dealing in a little smaller company in the audience today. How would you counsel them to think about their balance sheet, income statement, and the benefits and risk of debt?
Yeah, I think one is really just understanding completely what you're getting into in terms of the risk management of this. Thinking about downside scenarios and what might not happen, and your ability to tolerate and kind of manage around that, I think is really, really important. I think overall is just you want to maintain. I mean, too much leverage, can be toxic, as you were saying, basically. So really looking at, people often look at, talk about debt to equity ratios of maybe you don't want to exceed 30%. It's probably the maximum you'd want to get to in terms of debt as a percentage of your capital structure. And the other thing I'd say about that is people take this on is one, that there's risk, and I think it's really important that you're advising all key constituents within the business about what those benefits and risks of the debt are effectively. So whether it's your board, your equity holders, and really your leadership team too, and the team in general, that this is going to cause us to have to think a little bit more cautiously or thoughtfully about how we manage our cash and so forth. And I think within that, it's really incumbent on that the financial disciplines around your cash and kind of controls around monitoring what's happening with your revenue and just your financial control environment just needs to be stronger than if you just had equity because of the risk of downside there, and kind of driving that awareness through the business so that you're managing more tightly than, say, in an unlevered situation.
Jennifer, you see a lot of startups staying on this earlier stage startup. You mentioned quickly revenue-based financing, gave a little bit of a background on that. There's also there's factoring receivables, there's equipment inventory lending, there's all sorts of different things. Although young startups sometimes don't have these things. What are you seeing in the market? Anything color you can give us on the different types?
Yeah, there's certainly a huge menu of options to choose from, and like I said, there's a lender for just about everything. I will say factoring has had a big uptick recently, and so factoring is the concept of, let's say you've got a big account, a big customer order you need to fulfill, and you don't have the funds to go manufacture and buy your supplies, or they're going to be a slow payer or something like that, and you've got this receivable coming in, but you need the cash. What you do is you essentially sell that receivable to what's called a factor, and they get paid back a portion of what you get paid. So think of it like a payday lender almost, but it can be expensive, but it can also be critical. And I think that's sort of the balance I try to take when I'm counseling clients through this. There might be something I say, wow, that's completely off market, or that's very expensive, or that's a lot of risk. How badly do you need it? And sometimes they say, this is my only option. And so my job then is to, protect as much as possible and sort of just counsel you through here. Okay, that's great. Let's do it. Here's the risks. Like Mike said, making sure your stakeholders know what's going on can be really important in those scenarios, because you don't want them to be upset that, you signed on to some crazy deal that they didn't know about, and it's going to put them, again, bottom of the stack. And then, what I always say is being transparent with your lender is also really important as you get into, it doesn't matter what kind of debt. It's the cover up, it's never the crime, and no one's doing crimes here, but you've blown a financial covenant, you're running into trouble, you can see 3-4 months down the road, you're not gonna be able to make payments. Start the conversation now with the lender. It can be painful, but it's a much better case than when I have clients coming to me and they're already in deep and they've missed 3 payments, and now there's not a lot I can do. And just for context, understanding what's going on at the lender, right? So once you've missed payments, you're no longer with your relationship person, you're moved into special situations and there's nothing they can do. So just, again, trying to understand where you are, what the instrument is, what the risks are, what the pain points are, is really important as you go into these things. And again, you can do it fast, and sometimes you just need the financing, you gotta move on, but taking that few minutes to just make sure you fully understand what's being signed up for.
Mike, I don't know if you have anything. I know you've seen a million things in cash management. If there's anything to add on that, and then if not, we're going to, just kind of go into banking relationships a little bit because it's a very critical part. And I think we should talk a little bit about, Silicon Valley, how important they became to the startup community, what happened, how's that changed things for us. I don't know, Mike, if you have anything first, or we can turn it back to Jennifer. It doesn't matter.
Not really. I think what you said about really just being, communicative with your lenders, I think is important in good and bad times, basically. And, people don't like surprises in general. And I think it's more around cash management. It's things around, that your receivables are coming in quicker. You're looking at your outflows. It's just that it just needs to be more disciplined. Cash is king definitely needs to be kind of a more of a mentality when you're, managing in a levered environment.
Jennifer, you must have had your phone ringing off the hook with the Silicon Valley situation. What did we learn? Kind of what's changed since then? What advice do you have for startups with regard to debt and banking?
Yeah, I think what I've learned most recently actually is people have short memories. So that was only about a year and a half ago. I mean, venture debt is back. It is out there. It's everywhere. People are doing it. I think what's good that came out of it was companies are much more focused on cash management now. Because if you remember, part of the issue was they had their debt facility and 100% of their bank accounts in the same place, which is a requirement. I could give a whole lecture about why it's a requirement, but then they couldn't draw the cash. They couldn't make payroll. They couldn't pay their bills. People had to furlough because they knew they couldn't get to their cash. So a good thing that's come out of it is now every single venture debt facility that I do with a bank, I'm now seeing you have a special permission to keep 20% at least outside of your lender's bank to protect against that. Now they're still going to have limitations and controls, but it's given people a lot more of a focus and understanding that, your lender is your lender. And I think part of it was this idea of it's our partner and, we do all this stuff together, and that's still true, but remembering like at the end of the day, right, there's a relationship there and one's got the power and the cash and the obligations, and then you're answering to them. So I think that's sort of what came out of it, but it is great to see that the industry bounced back, and actually there's a lot of new players in the space at all levels in private credit, not just the banks. So it really opened up, I think, a lot of opportunities for early stage companies.
Yeah, no, so sometimes out of the worst situation, something good comes out. It's interesting, we've talked a lot about cash management today because we're talking about debt, and we're going to people that care an awful lot about cash management when they give you their money. I'm just thinking here that advice on cash management and the use of banks, we've started suggesting multiple bank relationships. Mike, do you have any feelings toward that? And Jennifer, your clients, what they ended up doing?
I mean, that has been a big feature post-SVB is looking at concentration of cash, where it sits, and being in multiple banks versus fully levered and having all your cash into one place. I'd say that is what SVB told us is that things can go wrong, right? They're a good example of what too much leverage can bring you, basically. So I think that kind of diversification of your, where your cash is, but also understanding just, there's some institutions, a large like a JP Morgan or something like that, you're going to feel pretty good that they're not going anywhere, basically. So being cognizant of kind of just the solidity of those banks, I think is important, because I think if banks are more in trouble, if they're not in a better situation too, they're probably going to be a little bit more conservative, or if you get into trouble too. So that's something to be mindful of. But all that said, though, I think it's important to pick people in cash management and good banks that can offer you a lot of different services and things like that, because like factoring becomes something you can do, and just just there's better tools and how you kind of manage things and relationships, and because they're in tune into your markets and so forth. So those are kind of the things I think about with post SVB.
Yeah, I think one interesting thing I've noticed is investors, and I'd be curious your take on this too, is investors have started asking more about cash management. One thing we saw was directors and officers of a company can be liable if a company doesn't make payroll. So that's like one of the few places where you have direct liability, and it's treble damages. It's really bad. So we had investors who were on boards of these startups who were suddenly like, oh my God, like now I'm on the hook for this. So they're starting to ask questions. We had one client who actually was doing fantastic, had this great facility. They had tens of $millions in cash sitting in a bank account, in a deposit account. And the investors never realized it. But because of this situation, the investor said, wait a minute, it's just sitting in the deposit. It's not in a money market. It's not, you don't have a sweep. So they've started asking a lot more questions to just look at the cash and how it's being used, where is it being used, what are you doing with it, do you have this bank account? And it's really becoming a driver. I'm hearing it mostly from investors to say, like, make sure you're set up the right way.
Yeah, we actually, every term sheet has some cash management things in them. And honestly, they used to just be the paragraph that the lawyers stuck in there, and now they have conversation almost on every deal. I want to double back to revenue financing for 1 second. A couple of things. First of all, Kevin O'Leary, Mr. Wonderful, was actually my client when I was in sales going back to the 80s, and the audience should know that he refused to pay my bill. I only ended up collecting about 80 cents on the dollar, so his grinding of people has been with him for life. But back to revenue financing, it's not always just purely against revenue is and a royalty payment, sort of like you said. It can be in the form of regular debt. There is more progressive lending that is going on once you get up to a certain, say, SaaS recurring revenue level. There are lenders that will just lend against that, which is different than factoring a little bit, because they're lending against future contract revenue as opposed to it's just different, and it's not necessarily being tied to a royalty payment. So it's just more of a traditional debt. Very expensive money. You're talking 15, 16, 17% interest type money. But Mohammed, I just saw you flash into me. I just want to make sure I knew what the signal was. We have 10 more minutes. All right. Well, we're gonna get to major points, because every panel or fireside chat, whatever you want to refer to this as, we want to make sure that the key takeaways are very obvious. So I'm actually going to turn to Mike and say, two pieces or three, if you'd like, piece of advice, what you would really want the audience to walk away with from today's discussion about leveraging debt in a startup arena.
Yeah, I'd go back to kind of the pros and cons that I started with. It does provide you capital that's lower cost of capital, that avoids dilution and helps your returns on equity. But I just think it just adds risk to the business. That is going to add a new level of discipline and things like that you're going to need in the company. So, equity holders, higher risk, higher return, but there's debt holders got to protect what they're going to get out of their principal and interest. So those are the key things, I think. Is just, it can be valuable to the business, but there's just risks to be mindful of.
Jennifer, key takeaways?
Yeah, I think, my key takeaway is, as much as I've talked about the risks here, it's a fantastic tool, I think. You just have to, again, make sure you understand it, and you just have to be careful. And, I would say lean on your advisors, whoever they are, to talk through what's standard, what's market, what you can live with, bounce ideas off of. Communicate early and often with your lender and other stakeholders about it, and just never forget you have to pay it back. That's the overarching point on all of this. And again, top of the stack. So just keep that in your brain.
Yeah, and I guess I would say it's not just banks. Almost every state has some sort of a fund or organization focused on helping startups move along. I know Rhode Island has one, Connecticut, and Massachusetts we have Mass Ventures. Really great group over there, very smart people. They will dig in with your startup with you. I do think there's kind of a curve to when you can get debt. It's sort of like it's like you know, at $500,000 revenue, debt's a little tricky. It's still a little early. Once you get up to $1 million revenue, there are some levers you can start pulling, not a lot. 5 million, all sorts of levers. And then it also depends on the type of your business, obviously, how many more levers you might have. If you don't have inventory, you can't borrow against it. If you don't have equipment, you can't borrow against it. But there's lots of very creative ways that once you get up to larger revenue streams that you can borrow money, you can cut back on dilution, and it's a little bit like we all experience with our homes. Most people, homes end up being your best investment, and one of the key reasons is because of the mortgage and the leverage you get on it, and that leverage allows you to multiply your winnings. But on the negative, if you lose your job and you can't pay your mortgage, the world comes crashing down. The same thing can happen in business. If for some reason you can't make your payments, do understand that top of the stack is kind of in control of your destiny, and that's where debt always lies. With that, I'd like to open it up to questions. We've got some very, we really struggled with the exact structure today, to be honest, but we knew there's so many different ways you can talk about debt for companies. So we hopefully will have a few questions from the audience now. Go. I think they're going to bring in Mike.
Thank you. Good morning. Thank you for the presentation. One of the questions I'm thinking about is the differences, which you alluded to a bit, between going to a bank versus another source, and wondering if you could talk more about why you would go one route versus the other.
Yeah, so I think, so there's the traditional bank, for commercial loan, and you might go there for a small business loan. Then there's the venture lenders, the SVBs, HSBC, Comerica, Bridge, all those names. And I would say you're most likely going to get the better pricing with one of those banks. The flip side is they're much pickier about who they're going to finance, right? So you really got to have, a stellar balance sheet. Typically for those banks, I would say 90% of the time, you really have to have an institutional investor behind you before they'll even, have the conversation. And then there's private credit. And private credit can be riskier because they're not a bank, regulated with examiners, et cetera. Their whole model is taking big risks for big returns. The flip side is it's going to be more expensive, and you should definitely expect more dilution on any kind of equity kicker. So it's all a little bit of a trade-off on the terms that you'll get versus the risk they can take. And then there's other options like Mass Ventures. I think they do, they'll do loans. SBA does loans. The 7A program is fantastic. They're going to be smaller. So you really have to figure out, again, coming back to that question, like, do you need it? Why do you need it? How are you going to use it? If really what you need is a piece of equipment, right? There's equipment financiers who will just do that. So you have to understand what you want and then find the market. I would say the biggest difference I see is bank versus private credit, and it's an expense versus risk analysis.
Next question. They're going to bring you a mic.
How does your financing change the way you manage the business and growth if you're doing debt versus equity financing?
Mike, you want to take a shot?
Yeah, I'd say what it just requires is a lot more focus on cash management. And I'd say how closely you're looking at that and how stingy you're being and where you deploy it effectively, because you need to have that cash to ultimately pay it back. So again, I think it's the disciplines around liquidity management and managing your cash flow, whether it's being thoughtful about your payment terms with your customers and how quickly those receivables are being paid, and how is also just the cash available in your bank, just how just when you're going to spend that. Basically, I think you just have to have really tight controls and not get surprised as to the level of cash that you're managing.
And to be clear, defaulting on a loan if you have a good business, does not necessarily mean Chapter 11's coming or your equity's all going to get wiped out. The banks and the people lending you this money want you to be successful. And so, I think I mentioned I was part of a leveraged buyout as an executive, maybe I didn't mention, of a public company. And we borrowed a lot of money when we bought the company back, and then we didn't execute the business quite as well as we had hoped, and we ended up breaking covenants, some of those ratios that Mike talked about. And so all that leads to is a strategic review by your credit facility to sort of say, what happened, what went wrong, what's the reality, what's going to happen over the next 12 or 24 months. And let's talk about, what ratios you can live with and possibly restructure the way the debt sits on your balance sheet. Now, it's costly. Like, the bank wants something in return for this restructuring, so you're going to pay them a refinance fee, and you're going to your terms are going to change a little bit, possibly. But as long as you're running a good business, you're transparent with the person lending you the money, you have a growth positive story to tell them that is believable. I just want to emphasize, breaking a covenant does not end your company. Any more questions? They'll bring you a mic. One sec.
Hi, thanks for everything. I was just curious, a lot of this is new to me, financing in general. I have some background in finance and mathematical background in physics mostly, but I was wondering if there are any resources that you're aware of that are good for learning more about not only debt financing, but financing in general.
Yeah, I think so. This is a common conversation actually we have with founders, because usually you've started the business because you're not a CFO or a financial person, right? I would say certainly reach out to people in your network. Start there. See if you can talk to someone like a fractional CFO. Like, sometimes that's an important step in bringing someone in your business. Honestly, your best friend is Google. Like, there's all kinds of information out there. And I would say, for me, it depends how you learn, right? There's all kinds of spreadsheets that will walk you through a balance sheet and give examples and play things out. So find something that works for you, but don't try to do it yourself. Call on those experts and go to things like this where you can learn more about it. It takes, if you're not familiar with it, it takes a little while.
I would agree, but I would also emphasize most founders don't have a command of all these things. It's very normal. There's no reason. They don't necessarily teach you this in school. They don't teach you this in business school. And so when companies come to Launchpad, we always request 5-year financial statements. And we see very sophisticated, overly engineered models all the way down to basic models that don't take into so many considerations that need to. I will say this, the most important thing we see missing, and we see it missing an incredible amount of the time, is the concept of milestones. It's sort of like, most founders think they're going to grow a little faster than they tend to. That's the optimism of the founder. We love that. We want the founders to believe in their idea. But we don't see them tying very tightly, what milestone am I going to hit, and then what financing opportunities does that unlock for me? Does it unlock a debt opportunity, or have I done enough to earn the right for another equity financing at a higher valuation? And so that level of thinking, but I do agree, conferences like this are a great place to learn things like that. But we spend an awful lot of time at Launchpad when we're doing a seed financing, working with the founders on their models, because it's not, again, it's not something that's taught at college very, very deeply. In the back, we have a question.
Thank you. My question is about, in general, a company, a startup company that's looking for funding through the normal trajectory of angel investing and moving on to VCs or something like that. Do they mind if it is any bank loan involved or not?
Well, I'll take it, and you guys can comment afterward. But I mean, just a pure bank loan. I mean, it changes the cap table and how you think of valuation a little bit. It depends, the size, duration, and reason for the bank loan. If it's debt that's got to be paid back as part of the raising, that's a very difficult thing for new investors to swallow. In other words, if you're going to, say, come to Launchpad with $250,000 in bank debt, and the bank says on your next financing you have to pay this back, that becomes a less attractive investment for us, because instead of giving you $1 million to grow, we're really only giving you $750,000, and we're sort of paying back $250,000 that you used to grow prior to us investing. I don't know if that logic made sense. So yeah, it's not ideal. But if it's debt that can stay on the balance sheet, that's not egregious or usury in terms of interest rate, it can be very helpful. It can make the investment more attractive potentially. Example would be if that debt is used to produce your product, and we know we're going to have to produce more. It's the beginning of a credit line that could get better and better, and we are getting the benefit of leverage a little bit, not having to use equity for that debt. So I don't know if Mike or Jennifer have any other thoughts.
I think I'd agree with that. I think it depends on the type of loan. I would say where I've seen it as a problem for our operating company clients is they come in, again, with some product that is just really aggressive, and the investors don't want anything to do with it. And that's where I go back to my original advice, is talk to your advisors before you do something, because I've had this conversation. I say, you can do this. Any investor coming in is going to hate it, right? And that's fine as long as you go in with eyes wide open. But I would agree, if it's a traditional, commercial loan or bank loan that's going to stay in place, I've never seen it cause a problem.
And back to the concept, I think Jennifer said earlier, fractional CFOs early are very good things to lean on. There's plenty of them out there in the Boston market with just unbelievable levels of experience that can help you, that I think you should consider leaning on. The other thing that we didn't touch on today, another financing thing, if your startup's actually building a product, the likelihood that as you start scaling that you're going to become a manufacturer is probably pretty low in this day and age, and you're going to actually end up using a contract manufacturer to produce your first 100, your first 1,000, or maybe even forever. Those organizations also lend money to startups. And so as part of your contract manufacturing negotiation, you often can tie in a loan. I think one more, or we can be done. It's just see if there's any other questions in the audience. Well, thank you, everybody. And Mohammed, I'm going to bring you back up to bring us home here.
Well, thank you so much, everyone. Thank you for your time. And we do have a lot more in store for you today and the rest of the week as well. We have our keynote with Yvonne Howe, Secretary of Economic Development, and Boston Globe's Scott Kersner, right here at 6 p.m. today at Suffolk University. Well, now in this room, if you're staying, at 11:30, we have Scaling Beyond Series A, Navigating Growth and Challenges. And you don't have to change rooms. Our team will come around, scan your QR code, and you should be all set. But it's fine. If this is not your vibe, well, you can go out and we'll take care of you right at the registration desk as well. And yeah, for those of you that are joining us virtually, please hang tight, sit tight. We'll be right with you in a moment. Lastly, for those of you that are in early stages of your startup, this Friday, you'll get the opportunity to share your venture at the Boston Startup Week closing party. So check out the Startup Showcase open mic information at the welcome desk in the first floor lobby. And again, please give a round of applause to our panel and our moderators. And you have plenty of time to catch up with them, take pictures, and yeah, connect.